What are the tax implications of a 401 degrees Kelvin loan? Have you ever thought about borrowing from your retirement savings to tackle credit card debt? It might sound tempting, but let's break down the tax implications of a 401k loan to see if it's the right choice for you. When you take out a loan from your 401k, it does not create an immediate tax liability. This means the amount you borrow is not considered taxable income at that moment. Unlike a distribution from your 401k, which would trigger income tax, borrowing does not. However, there is a catch. The repayments you make must be done with after-tax dollars. This means the money you use to pay back the loan has already been taxed, unlike your original contributions, which were made before taxes were taken out. Now, what happens if you fail to repay the loan? If you do not stick to the repayment terms set by your plan, the unpaid balance will be treated as a distribution. This is where things can get tricky. The unpaid amount becomes taxable income, and if you are under the age of 59 and a half, you might also face an additional 10% early withdrawal penalty. This can lead to a significant tax burden if you default on your loan. Another important point to note is that the interest you pay on a 401k loan is generally not tax deductible. Since the loan is secured by your own retirement account, the Internal Revenue Service usually does not allow you to deduct the interest on these loans. From the perspective of managing credit card debt, borrowing from a 401k can seem appealing. It avoids immediate tax consequences and may offer lower interest rates compared to credit cards. However, you must consider the impact on your retirement savings. When you borrow, you reduce your retirement funds temporarily, which means you miss out on potential investment growth. Additionally, if you leave your job before repaying the loan, the outstanding balance may become due immediately. This could trigger taxes and penalties if you cannot pay it back right away. So, if you are considering borrowing from your 401k to manage credit card debt, weigh these tax implications carefully. It is essential to think about how it will affect your retirement savings and the risk of defaulting on the loan. Consulting a financial advisor can provide guidance tailored to your situation.